All right, so let's talk about markets. And I'm not going to go deep into any of the markets in particular, but I do want to give kind of a sweeping overview of what is available to day traders. And there are actually quite a lot of options available to day traders all around the world. It's not just even in the US, but you have European markets, you have Asian markets, you have US markets. And then within those bigger markets, you have products, you have, you know, stocks and bonds and options and all these other things. So the one that most people are familiar with is the stock market. And the stock market are where you can trade stocks on individual companies. So whether that's US based companies or companies in Europe or elsewhere, you can take an individual company and you can trade, day trade on that company's stock movements, whether they're going up or whether they're going down. And the great thing about stocks is that there's a ton to choose from. And in a lot of cases, some of the stocks are very liquid. So when you get something like an Apple or a Google, there's a lot of people that are buying and selling Apple and Google stocks. There's a lot of participation. It's highly liquid. Or maybe you're into stuff that's, maybe moves a little slower. And so you can kind of find exactly what you want, what suits you from the stock market. But it's also it's like an ocean of opportunity, which can be its own challenges. Finding the stocks that resonate with you, that work with you, that maybe work with your system can be a little bit challenging. Some people, they don't trade, maybe they trade a basket of stocks and they're looking for characteristics, technical characteristics that happen in any one of those. So they're not necessarily watching Tesla all day. They might be watching for a moving average breakout. And if Tesla, Apple, Facebook, Google, any one of those break out, then they're into that stock. So that's kind of like stocks in play type of environment. So stocks offer a lot of opportunity and they trade, depending on the market exchange. So there was active hours, usually, if it's a US based stock, it's during the US market hours and so on and so forth. Now, let me tell you the downside of stocks and the reason that I don't recommend starting to trade stocks right off the bat from a day trading perspective. And this goes for options as well, but there's something called the pattern day trader rule. So it's a rule within the US environment. And I don't think this has an application outside of the US, but within the US, it's called a pattern day trader. And what it means is that if you intend to day trade stocks, you need to have a minimum of $25,000 in your account in order to trade it. It's kind of a protection mechanism for consumers to make sure that we have enough capital to be able to trade and day trade, something that our government put in place to protect us from ourselves. So the pattern day trader rule means that you cannot trade stocks on a frequent, in and out during the day basis unless you have $25,000, at least $25,000 in your trading account. So there's that rule. Then there's the wash sale rule, which is really, really detrimental to traders. And it's a tax rule that basically states that, it basically doesn't let you net out your returns on an individual stock. So if you make multiple trades in a day on a stock, you have net gains and net losses. And let's say you lost $500. Well, because of the wash rule, the IRS may say, well, according to the wash rule, you didn't actually lose 500, you gained 5,000. So you have to get taxed on that. And it's just these weird tax rules that add more, not only, challenges related to profitability because you can get taxed when you actually realize a loss, but also a lot of overhead related to reporting. So, from that perspective, I'm not a big fan of stock trading. It's hard to find stocks, kind of the right basket of stocks. And, you have a lot of weird tax rules. You have the PDT rule and you have some other things. So while that is the market that is the biggest and most people are familiar with it, I don't think it's the best market to start with. So we're going to look at some of the other markets. So if we kind of move from stocks to options, options are basically derivatives of stocks themselves. And options are also incredibly technical. They're very mathematically oriented. They are the most complex instruments to learn how to trade and learn how to master. And so you can lose everything with an options play because whereas a stock, you're kind of owning the stock. If you are, you know, putting on a short sale, so to speak, for lack of a better term, with an option, you could potentially, that if the stock goes against you, you could potentially lose everything in your account. And so there's a lot of risk associated with options if you don't understand the real deep technical financial aspects of how options work. And there's some really complex models associated with those. So that's another one that I kind of tend to stay away from as well. So then we have the foreign exchange market. So it's called the Forex market. And this is a intrabank currency market. So banks are always doing business with each other to transfer money from one bank to another. And when you have overseas transfers from one currency to another, that's an interbank transfer. One bank, transferring assets into another bank, right? And so there's trillions of dollars that are transferred every single day within this interbank system. And the challenge with the Forex market, so there's some really positive things with the Forex market. So first of all, it's a huge market. So there's tons of liquidity in this market. It trades 24 hours a day in every region around the world at any time. So it's a really active market that trades all the time. And that's kind of the appeal for a lot of people when they come into the Forex market, is this ability to trade anytime, anywhere, lots of liquidity, lots of movement. And so you get these kind of nice conditions from a trading perspective. But there is a trade-off. There is a downside. And a couple of the downsides are, one is currencies can be manipulated by their host governments. So, Japan is famous. Their central bank is kind of infamous for manipulating the Japanese, currency. China as well. There's other stable currencies, the Aussie dollar, the US dollar, the British pound, the euro. They're pretty stable. There's not a lot of manipulation going on there. So those are pretty good. But you do get some weirdness with some of these off currency pairs. But the real challenge is that there's no central market exchange for all currency transactions. Because when you sign up with a broker, you're really getting access to one group of connections between a group of banks. And it's like there's these hives associated with different banks and their different connections all around. And so you never get a full picture of the entire market and what's happening with the entire market. You only get a snapshot of what's happening with your banks that are connected together. So your intrabank market that's connected. And so you're almost getting just a portion of the whole market. Not really a problem necessarily, unless you're using volume or some other aspects of volume to make trade decisions. Then you're not actually getting a complete picture of the full volume of what's taking place. So it's a more decentralized network that makes it a little bit more challenging from that perspective. Forex is great. I started in Forex. I did a lot of my early trading in Forex, and there's not a lot of currency pairs to choose from. You're trading the euro dollar, the Aussie dollar, the Canadian dollar, or the pound to the dollar, or the euro to the pound. Like there's a few major pairs that you tend to trade. So there's kind of a finite number of instruments, which means it's kind of easy to learn one of these pairs versus the stock market where you have thousands of stocks to choose from. But there are some other of those trade-offs relative to, not having a central exchange. Brokers, it's kind of a little bit of the Wild West. You get a lot of slippage in your orders, and slippage means, I might be trying for one price and my broker gives me another price, and I lose a little bit of money off of the price difference between what the broker will fill me at versus what I actually get. So there's just some little, kind of weird things that happen in that particular market. So there's the Forex market. And then there's the futures market. And I love the futures market. Like, I'm not going to lie, I think it's fantastic. It has all the benefits of having a centralized exchange, so one view into everything that's happening in the market, tons of volume, tons of liquidity, lots of large players, lots of small players, reliable brokers, really good regulation. Like I could just name off and tick off one benefit after another, after another, after another. And so the futures market is really, for me, the best market to learn in. It's a stable market. It's a market that has very good, centralized data that goes back to, roughly 2008. So you get a lot of data, and that's going to become important to us as we start looking at data flow and what's available in data flow. So when you're trading in the futures market is really trading on commodities. So it started out in, different, actually futures markets have existed for, hundreds of years, and they're kind of created to help the flow of commodities from one place to another. Our modern day US based exchanges started really in Chicago. They started with cattle, and now you can trade anything from cattle to sugar to oil to natural gas to frozen orange juice concentrate. Like you have pretty much all of these things. And then you have currencies, currency futures you can trade. You have index futures, so the S&P 500 index futures, the NASDAQ futures. You have precious metals, so gold and silver and platinum. And obviously you have crops, wheat and corn and soybeans. It's just, there's some great products that are there with lots of liquidity, lots of movement, lots of, good centralized support that you can trade with the futures market. So it's pretty cool from that perspective, in that you've got, enough things to choose from that can fit your style, but not so much that you're overwhelmed. And then you've got this market that trades 24 hours a day with lots of liquidity, lots of worldwide global liquidity, with very consistent, stable data and no shocks, right? Like one of the downsides I didn't mention in the stock market is, what if you're trading a particular stock and all of a sudden the CEO goes on, let's say he goes on a podcast and he, smokes a joint, and all of a sudden his stock starts tanking because people are like, what is he doing smoking pot on a podcast? That actually happened. That was Tesla CEO Elon Musk. So you don't get these weird shocks that happen with the futures market as well, which is pretty cool. So when you're trading in the futures market, you get your choice of all kinds of different things that you can trade. And you end up with something where you have a lot of stability, you have enough products to choose from to find something that works for you. And it's a worldwide global market that is open 24 hours a day. So it has a lot of the benefits that Forex has, but the added benefits of the stability, the liquidity, the centralized exchange, right? All of these wonderful things. Now, Forex and futures have a really unique benefit for US-based people. And I don't know about this in other countries, but I know within the United States, one of the biggest benefits is, we talked about that pattern day trading rule and wash sales. None of that exists for futures traders, futures and Forex traders. So when you're trading these products, you are classified under this special rule called Section 1256 contracts. And if you looked up the IRS definition, Section 1256 contracts, what happens is every, your net gain and loss is calculated based on the Section 1256 contract rule, which means that your tax is not a short-term or long-term capital gain. So if you're in stocks, you might have a day trading, you're going to get short-term capital gains taxes, and they're pretty high. They're pretty significant. And that's no good. And then you get the wash sale hit on top of it. When you trade futures, it's split between, I think it's 40% short-term and 60% long-term is the split, the tax bracket split. And there's no wash sales or anything like that. So at the end of the year, all you have to do is report your net income from your net gain from futures, and that's taxed at this 60-40 long-term, short-term capital gain split. So, when you talk to your accountant, or you go through the taxes yourself, you'll realize this is a huge benefit. This actually helps your profitability in the end as well is the fact that you don't take this really big tax hit at the end of the year as well, which is pretty cool. So those are kind of the major markets that are out there. You've got the stock market, you've got the options market. We didn't talk about the bonds market, but that's totally different too. You've got Forex, you've got crypto, and you have futures. And my favorite is the futures. You're going to learn how to do the futures market, but the things that you learn in this program, you can absolutely take and apply elsewhere. And even if it's options, you'll have to learn new systems, new ways to trade, maybe some of these other markets, but the core fundamental aspects of becoming a consistently profitable trader that you'll learn here are things that you can take with you anywhere.